If you currently own a home somewhere in the Carolinas, are planning to buy one soon, or are trying to put your property on the market, you need to pay extremely close attention to what we're about to reveal. The housing situation across both North Carolina and South Carolina is doing far more than simply slowing down in a few isolated areas. In many places, the market is starting to completely unravel. What makes this even more alarming is that the numbers now coming in look worse than anything we've witnessed since the financial collapse back in 2008. South Carolina has officially recorded the highest foreclosure rate in the entire United States. More homeowners there are falling behind and losing their properties than in any other state across the country. But foreclosures are only part of the bigger problem unfolding right now. We've been monitoring 10 different cities throughout the Carolinas where pressure is hitting buyers, sellers, and homeowners all at the same time. In one of these markets, nearly 70% of homes listed for sale have already gone through price cuts, while properties are sitting unsold for more than 4 months with almost no buyer activity at all. In another city, a devastating natural disaster triggered a massive surge in mortgage delinquencies, increasing faster than in any other metro area in America. Out of all 384 metro regions being tracked, this one saw the sharpest spike, and so far there are very few signs that recovery is anywhere close. And the final city we'll cover is one almost nobody is paying attention to yet. Still, it may end up being one of the most shocking examples on this list. In just a single year, the average number of days homes spent sitting on the market skyrocketed by 126%. Everything we're about to break down comes from sources including Redfin, Atom Data Solutions, the Mortgage Bankers Association, Canopy MLS, and multiple local housing reports we've been following closely for months. If you plan to make any real estate decision anywhere in the Carolinas during 2026, this could easily be one of the most important videos you watch all year. Make sure to hit the like button so more people see this information, and let's dive right in. Number 10. Fayetteville, North Carolina. We're beginning with a city that barely gets mentioned by most real estate channels, and honestly, that lack of attention is part of what makes the situation so risky. Fayetteville has long been known as a military-driven town centered around Fort Liberty. For decades, the base helped stabilize the local housing market. The pattern was predictable. Military families would move in, purchase homes, receive reassignment orders a few years later, and then either sell those properties or turn them into rentals. That steady cycle kept the market moving and created a sense of security underneath local home values. But right now, that system is starting to crack. According to Atom Data Solutions, Fayetteville ranked as the fifth worst metro area in America for foreclosure filings in January 2026. Earlier, during the first half of 2025, the city had already posted the sixth highest foreclosure rate in the nation among metro areas with populations above 200,000. The warning signs don't stop there. Job postings across the area plunged by 42% compared to the previous year, marking the sharpest employment decline of any metro in North Carolina. At the same time, Redfin reported that 68% of Fayetteville home shoppers were actively searching to leave the city instead of stay there. That number matters more than most people realize. When a majority of residents are looking for a way out, it gives you a very clear picture of where future housing demand may be headed. On the surface, the market still appears relatively stable. Median home prices climbed to roughly $298,000, increasing by just under 3%. But those headline numbers are hiding a much larger problem developing underneath. A huge wave of distressed properties is quietly building in the foreclosure pipeline right now. And once those homes begin flooding onto the market over the next 6 to 12 months, they could put serious downward pressure on prices across the entire area. So, if you're stationed at Fort Liberty and someone is encouraging you to buy property there, make sure you carefully run the numbers yourself before making any decisions. And if you think a military town dealing with rising foreclosures sounds concerning, just wait until you see what happened after a major natural disaster slammed into a housing market that was already overloaded with inventory. Number 9. Asheville, North Carolina. Asheville has built a reputation as one of the most charming and visually stunning cities anywhere in the Southeast. Surrounded by the Blue Ridge Mountains, packed with craft breweries, art galleries, music venues, and a thriving creative culture, it's the kind of place people instantly fall in love with the first time they visit. But behind all that beauty, the housing market is now facing a very serious crisis. At the moment, Asheville carries a distinction that no metro area wants attached to its name. According to data from Cotality, this market recorded the largest year-over-year jump in mortgage delinquency rates out of all 384 metro areas across the United States. Not one of the worst. The absolute worst. A huge part of that surge was triggered by the aftermath of Hurricane Helene, and the effects are still rippling through nearly every corner of the local economy and housing market. Home prices have already started sliding downward in a noticeable way. The median sale price now sits around $459,500, which is down more than 7% compared to a year earlier, according to House Canary data. In nearby Henderson County, average home prices dropped even harder, falling roughly 12%. At the same time, sellers are being forced to cut prices at an extraordinary rate. More than 80% of all active listings in Asheville have already gone through price reductions, the highest percentage anywhere in North Carolina. And only a very small share of homes, somewhere around 8% to 12%, are actually selling above asking price anymore. The rental market is also weakening fast, and in some ways it may look even worse than the for-sale market. Apartment vacancy rates in Asheville climbed to 10.7%, making it one of the highest vacancy levels in the country. On top of that, the city's multifamily supply-to-stock ratio reached 7.65%, the highest in America and nearly 4 times above the national median. Rents have already fallen by more than 3%, and by some estimates, renting in Asheville is now about $776 cheaper per month than owning a home there. People genuinely adore Asheville, and it's easy to understand why. But buying property in this market right now could be incredibly risky. It's like trying to catch a falling knife while a hurricane is still attached to it. The damage here is not something that gets repaired in a few months. Recovery could easily take years. And if a natural disaster can destabilize a mountain city this badly, wait until you see what's happening in the state capital, where the problem isn't a hurricane at all. It's thousands of homeowners quietly sinking under overwhelming debt. Number 8. Columbia, South Carolina. Columbia tends to catch people off guard on a list like this because, on the surface, it looks like one of the more stable markets in the region. As the state capital, it benefits from government employment, the presence of the University of South Carolina, and a cost of living that has traditionally been considered more manageable than many other growing cities across the Southeast. But once you look past the surface-level numbers, the picture becomes much more concerning. According to Atom Data Solutions, Columbia ranked as the second worst metro area in the entire United States for foreclosure filings during 2025, with one foreclosure filing for every 165 housing units. Think about how serious that is for a moment. Out of every metro market in America, Columbia landed near the very top of the foreclosure crisis rankings. And the situation didn't quickly improve afterward either. By February 2026, the city was still sitting as the 5th worst metro nationally for foreclosure activity. That tells you this is not some temporary spike or one-month anomaly. It points to a deeper and much more sustained level of financial strain spreading through the market. What makes Columbia especially difficult to read is that many of the headline housing numbers still appear fairly healthy at first glance. Median home prices remain around $252,500. Properties are spending roughly 50 days on the market. Sales volume has even increased by about 7.6%. If you only skimmed those statistics, you could easily walk away thinking the market was holding up just fine. But the foreclosure pipeline underneath those numbers tells a very different story. A growing number of homeowners are clearly under pressure financially, and much of that distress has not fully surfaced in home prices yet. South Carolina Realtors CEO Nick Kremidas explained to South Carolina Public Radio that inflation combined with much higher interest rates has been squeezing buyers who purchased homes near the top of the market. As more distressed owners move through the foreclosure process and those properties eventually hit the MLS, they could start dragging down values across entire neighborhoods, not just isolated homes. One area where Columbia still has an advantage over some of the coastal markets we'll discuss later is insurance costs. Homeowners there are paying around $1,968 per year on average, which is still less than half of what many coastal property owners are now facing. Even so, Anyone considering buying in Columbia should keep a very close eye on those foreclosure trends before jumping into the market. And if this information is changing the way you see these housing markets, take a moment to subscribe. We follow these numbers every single week so you don't have to. Because the next city on this list is one that many people still describe as a guaranteed winner, even though the latest data is starting to tell a completely different story. Number 7. Greenville, South Carolina. Greenville has spent years being treated like one of the standout success stories of the Southeast housing market. With major employers like BMW and Michelin anchored in the region, plus a walkable, polished downtown along the Reedy River and steady growth fueled by the Interstate 85 corridor, it's easy to understand why so many people have been drawn here. For a long time, real estate agents have leaned heavily on that story, positioning Greenville as a reliable, almost can't-go-wrong kind of market. But the early 2026 data is starting to tell a much less comfortable version of that narrative than what most buyers are hearing. According to Redfin's February 2026 figures, the median home price sits around $463,000, but that number is already down roughly 6.6% year over year. At the same time, inventory across the metro has climbed sharply, reaching more than 5,400 active listings in March, which represents an increase of over 28%. Homes are also taking significantly longer to sell. The average days on market has stretched to about 92 days, which is nearly 48% slower than it was just a year earlier. But the clearest sign of shifting power in the market comes from bidding behavior itself. The share of homes selling above asking price has dropped dramatically, from about 33% down to roughly 7%. That's one of the steepest reversals seen in any South Carolina metro. Not long ago, roughly 1 in 3 buyers was willing to pay over list price. Now it's closer to only 1 in 14. On the employment side, there are additional pressure points forming. Milliken & Company is closing its Cedar Hill facility, resulting in about 126 layoffs. Meanwhile, Saddle Creek Logistics Services has cut around 130 jobs. In nearby Spartanburg County, foreclosure activity has also climbed, ranking among the highest in the country. Even rents across South Carolina have effectively slipped back to 2024 levels, erasing a couple of years of growth according to South Carolina Public Radio. To be fair, Greenville still has something many other cities on this list don't: a relatively stable manufacturing backbone that helps soften the blow compared to more fragile markets. But even so, with inventory rising and prices adjusting downward, buyers need to be extremely careful not to pay last year's prices in a market that's clearly shifting in real time. And everything we've looked at so far has been inland. Next, we move toward the coast, where the financial pressure doesn't just increase, it gets significantly more expensive. Number 6. Hilton Head Island, South Carolina. Hilton Head Island sits firmly in the luxury tier of coastal living. It's known for retirement communities, high-end second homes, and perfectly maintained golf courses. Crossing the bridge onto the island genuinely feels like entering an entirely different world, one built around comfort, leisure, and exclusivity. But underneath that polished image, the housing market is showing clear signs of strain. Right now, homes on the island are taking more than twice as long to sell compared to just a year ago. In January 2026, the average days on market climbed to about 146 days, which is an increase of nearly 112% year over year. February didn't bring much relief either, coming in at roughly 134 days on market, still up around 116% compared to the previous year. Prices are also sending mixed and confusing signals. In February, the median sale price was around $485,000, which marked a drop of more than 19% year over year. Yet in January, the same market showed an 11% increase. That kind of sharp back-and-forth movement isn't stability. It's a market struggling to find a clear bottom. Another major indicator is how negotiations are playing out between buyers and sellers. The sale-to-list ratio is sitting around 96.5%, which shows sellers are now regularly accepting noticeable discounts just to close deals. Then there's the insurance situation, which is becoming one of the biggest hidden pressures in coastal South Carolina. Beaufort County is among a small group of coastal counties that collectively hold over 91% of the state's national flood insurance program policies. Flood coverage in these high-risk zones can add anywhere from $1,500 to $4,500 per year on top of standard homeowners insurance. Even more concerning, the number of condo associations relying on South Carolina's insurer of last resort dropped dramatically, from about 70 down to just 7 by the end of 2025. That shift means many properties either had to secure very expensive private coverage or are now operating in an increasingly difficult insurance environment. For anyone considering Hilton Head as a retirement destination, the key thing to understand is that the mortgage is only one piece of the total cost. Insurance, maintenance, and long-term risk exposure all add layers that aren't always obvious at first glance. And as costs continue to catch up with expectations along the coast, the next market we're about to look at is one that was widely considered bulletproof, until the numbers started telling a very different story. Number 5. Raleigh-Durham, North Carolina. This is one of the harder markets to talk about because for a long time Research Triangle was positioned as the future of American growth. The promise was everywhere: major expansions from companies like Apple, continued growth from Google, and a broader narrative that this region would become one of the strongest tech-driven hubs in the country. If you spend any time driving through Wake County, you can still see what that vision was supposed to look like. New suburbs, large tech campuses, mixed-use developments, and constant construction created the feeling of unstoppable momentum. For years, housing prices were pushed upward to match that optimism. But now, that momentum is starting to run into reality. According to Zillow, average home values are sitting around $439,000, which reflects a decline of about 2.3%. At the same time, inventory in Wake County has climbed sharply, with more than 3,500 active listings recorded in January, an increase of nearly 21%. Homes are also taking longer to sell. Days on market has risen to about 69 days on Redfin, up from 49 just a year earlier. That's a 41% slowdown in turnover, which signals cooling demand across the region. Forecast expectations are also shifting. Realtor.com rankings show Raleigh falling from 72nd to 95th nationally, while Durham dropped from 13th down to 41st. But what really makes this situation more serious than a typical correction is what's happening beneath the surface in employment. Several major organizations have reduced staff significantly. RTI International cut more than 736 jobs in 2025, including hundreds in North Carolina after federal funding reductions eliminated dozens of projects. Lenovo also reduced its workforce by 230 positions in Morrisville, while Duke University implemented roughly $229 million in budget cuts, with around 600 staff accepting separation packages. Across the state, tech-related job postings have dropped by more than 14%, signaling broader softness in what was once one of the strongest employment engines in the region. At the same time, the rental market is also weakening. Average rents have fallen to about $1,361, down 2.2% year over year and roughly 13% below the peak seen in August 2022. More than half of apartment listings, around 52%, are now offering concessions just to attract tenants. When you combine falling rents, rising inventory, and a cooling job market, you get a housing environment that is far more fragile than the national tech boom narrative suggests. And if the Triangle is already feeling this kind of pressure, the next market we're going to look at is Charlotte, where the same forces are playing out, but on an even larger and more intense scale. Number 4. Charlotte, North Carolina. Charlotte has seen a very rapid and very visible shift in its housing market, and for many people watching it unfold, the change feels almost sudden. If you drive into Uptown, the skyline still gives that classic boom city impression: glass towers, constant construction, cranes scattered across the horizon. On the surface, it still looks like a market that is aggressively expanding. But the data behind it tells a much less optimistic story. According to Realtor.com's 2026 housing outlook, Charlotte dropped sharply from 14th place nationally down to 71st in just 1 year. That kind of move isn't a small adjustment. It's a 56-position slide that signals a major shift in expectations for the market. Home values are also starting to ease. Zillow data puts the average price around $387,000, reflecting a decline of about 2.3%. At the same time, more than half of all listings across the metro, over 53%, have gone through price reductions as sellers adjust to weaker demand. Sales activity is slowing as well. Closed transactions fell by nearly 14% year over year in January. Meanwhile, homes are sitting on the market much longer, with average days on market jumping to about 88 days on Redfin data. That's up from 54 days the year before, a 63% increase in time to sell. Inventory is also building up quickly. By the end of January, nearly 10,000 homes were sitting unsold across the Charlotte metro area, adding even more pressure on pricing. But the most important issue in Charlotte right now isn't just the for-sale market, it's what's happening in rentals. The apartment sector is arguably one of the most oversupplied in the entire Southeast. In 2024 alone, more than 16,700 new apartment units were delivered, more than double the pre-pandemic average. And instead of slowing down, another roughly 16,200 units came online in 2025. That wave of construction has pushed vacancy rates up to 8.2%, while rents have declined for 2 straight years. Even more supply is still on the way, with around 27,000 units under construction and another 92,000 planned. On top of that, the office market is under severe pressure, with vacancy rates reaching an unprecedented 26%, adding further strain to the broader commercial real estate environment. When rental prices start falling like this, it changes buyer behavior. If renting becomes cheaper or more attractive than owning, especially with mortgage rates still elevated, it removes a major incentive to purchase a home at current prices. Charlotte remains a strong city with a solid financial backbone, especially thanks to its banking sector, but the imbalance between supply and demand in both housing and rentals is real, and it's not something that corrects overnight. For anyone thinking about buying here, this is a market where negotiation power has clearly shifted, and overpaying based on past momentum is becoming a serious risk. Now we move into the top 3, and this is where the situation becomes even more intense. We're heading toward the coast, where an insurance crisis is beginning to reshape what homeownership even means. Number 3. Charleston, South Carolina. Charleston is easily one of the most visually stunning cities on this entire list. Between the cobblestone streets, pastel-colored historic homes, waterfront views, and a nationally recognized food scene, it's the kind of place that instantly explains why so many people dream of moving there. Walking through the historic district, it's very easy to see the appeal. But underneath that beauty, the housing market is being pressured by something far less visible and far more powerful than aesthetics. Insurance. Homeowners in Charleston are now paying an average of about $3,270 per year in insurance premiums, which represents a roughly 22% increase between 2021 and 2024. And the bigger concern is that this trend is tied to structural risk, not temporary pricing fluctuations. Across South Carolina, the homeowner's insurance system itself is under strain. The statewide combined ratio reached around 144% at the end of 2024, meaning insurers paid out $144 in claims for every $100 they collected in premiums. That level is not financially sustainable, which usually signals one thing moving forward: continued premium increases. On top of that, risk exposure in Charleston is extremely high. Estimates from the First Street Foundation suggest that about 71% of properties in the area face severe flood risk over the next 30 years. When you add flood insurance costs, often ranging from roughly $2,000 to $4,500 per year, you can easily end up with total annual insurance expenses between $5,000 and nearly $8,000 before even factoring in a mortgage payment. And the housing market is already reacting. The share of listings with price reductions has climbed sharply, moving from around 6% to more than 20%. At the same time, homes selling above asking price have dropped from about 17% down to under 9%, showing a clear cooling in buyer competition. Inventory is also piling up. Active listings have reached nearly 4,500, which is more than double what the market saw back in 2021. Even the local economy has felt some pressure. Boeing has gone through multiple rounds of layoffs in the North Charleston area, totaling around 360 positions. And the metro as a whole recorded one of the higher foreclosure rates in the country, ranking 17th nationally in 2025. The key takeaway here is simple. Anyone considering buying in Charleston needs to think about insurance before anything else. Not after you fall in love with a property, but before you even seriously evaluate it. Because in this market, insurance costs can completely change what affordable actually means. And while Charleston is already dealing with significant pressure, what's happening just further up the coast is on an entirely different level of financial strain. Number 2. Myrtle Beach, South Carolina. This is the market we hinted at right at the start of this video. The one where roughly 70% of listings have already seen price cuts and homes are sitting for more than 4 months without moving. That city is Myrtle Beach, and right now it stands out as the weakest performing housing market in both North and South Carolina by a wide margin. It's not a close comparison. According to local realtor Blake Sloan's March 2026 market report, the situation is already being described in very direct terms. Condo prices have dropped somewhere between 11% and nearly 13% year over year. He even points out that any decline above 10% is generally considered consistent with a market in correction, or outright crash territory depending on context. At the same time, inventory is climbing quickly. Active listings jumped about 38%, pushing the total to more than 3,300 homes. Supply levels are now extremely elevated, with months of inventory reaching around 7.2 months for single-family homes and 8.6 months for condos, both well into buyers' market conditions. Homes are also taking a very long time to sell. Average days on market have stretched to about 124 days, which is the slowest pace seen since August 2020. And even when listings do get attention, it's minimal. Condos are averaging fewer than 2 showings across their entire listing period. The insurance environment is adding even more pressure on top of the slowing demand. Homeowners in Myrtle Beach are now paying around $4,772 per year on average, making it the most expensive insurance market in all of South Carolina. Recent FEMA flood map updates in 2025 have also expanded mandatory flood zones, adding another $1,500 to $4,500 annually for many properties. Some local agents are even reporting escrow payments jumping by nearly $580 per month, driven almost entirely by rising insurance and tax costs alone. On the demand side, the short-term rental market, which a large number of condo investors relied on, is weakening fast. Rents are down more than 6% over the past 2 years. Vacancy has climbed to around 9.2%, and many owners are now struggling just to cover mortgage payments and rising HOA fees, which have doubled in some developments. That combination is creating a difficult situation. Owners are trying to sell, but buyers are disappearing at the same time. And that's the key contradiction in Myrtle Beach right now. On the surface, it may still look like an affordable coastal market, but the ongoing carrying costs are extremely high, and asset values are still moving downward. If you're considering a vacation rental here, the reality is you would need to run the numbers multiple times, from multiple angles, before even thinking about buying. And the more important question becomes not just whether it works on paper, but why so many current owners are trying to exit at the same time. Now, we've reached number 1, the city that was mentioned at the very beginning of this video, the one most people still aren't paying attention to, but probably should be. Number 1, Wilmington, North Carolina. If you've been watching all the way through and waiting for this final reveal, this is it. Wilmington has just recorded the most dramatic surge in days on market across both Carolinas. And surprisingly, it's a shift that most national housing coverage has completely overlooked. According to Redfin's January 2026 data, the average days on market in Wilmington has jumped to about 77 days, up from just 34 days a year earlier. That's an increase of roughly 126% in the time it takes to sell a home, which is one of the sharpest slowdowns in the region. At the same time, closed sales have dropped by nearly 10%. Local MLS figures also show inventory rising to around 5.4 months of supply, which is a major turning point for a market that had spent years operating as one of the strongest sellers markets along the North Carolina coast. Wilmington itself still carries a lot of appeal. Downtown, especially around the Riverwalk, remains full of character, charm, and coastal energy. But once you zoom out to the broader metro, the listing data tells a much more complicated story. In nearby Pender County, active listings have surged by roughly 44% year over year. A big part of that increase comes from new construction projects that were launched during the boom cycle and are now all hitting the market at the same time. Builders moved aggressively into this corridor during the height of demand, But now that wave of inventory is sitting much longer than expected. In a relatively short period, about a year, this market has shifted from strongly seller-driven conditions to something much closer to a buyer-leaning environment. And because so much attention has been focused elsewhere on places like Charlotte, Raleigh, and Myrtle Beach, this slowdown has largely flown under the radar. The key takeaway is simple. Wilmington shouldn't be assumed safe just because it's less talked about. It deserves the same level of scrutiny as any other market on this list. Stepping back, the pattern across all 10 cities is becoming very clear. Markets like Myrtle Beach and Asheville are already showing outright weakness, with falling prices, rising inventory, and growing pressure from insurance or disaster-related costs. Meanwhile, Charlotte and Raleigh are cooling quickly under the weight of oversupply in both housing and rental sectors, along with emerging job market softness. Across the coast, from Charleston to Hilton Head to Wilmington, the common thread is becoming harder to ignore. Insurance costs and risk exposure are fundamentally reshaping what homeownership actually costs near the water. On a broader scale, South Carolina recently led the nation in foreclosure rates, while North Carolina saw one of the largest increases in mortgage delinquencies. Builders are increasingly responding with price cuts and incentives, and mortgage demand has softened as rates have climbed back into the mid-6% range. To be clear, none of this means the Carolinas are collapsing. People are still moving there, and demand hasn't disappeared. But anyone buying in these markets right now needs to understand the conditions they're stepping into, not just the headlines. That means doing your own homework, checking insurance costs before getting attached to a listing price, and recognizing that renting is not a failure. It can be a rational strategy while the market searches for a stable floor. If this breakdown helped you see the situation more clearly, make sure to like and share it with someone who needs a reality check on their local market. Stay subscribed because these trends are changing quickly, and the next update will go even deeper. And if you're seeing price cuts where you live, that's the kind of signal worth paying attention to.